2015 was an incredibly frustrating year for many investors, but it was also unsatisfying because, look, major market averages went literally nowhere. You had a lot of volatility, but it was also broad in terms of many asset classes not having a return. And it was as unsatisfying as that Chinese food dinner, and you're hungry an hour later and you say, did I just eat? I mean, that's the type of year that we had. 2016 is going to be a very different year. It's going to be the year of the underdog. It's going to be the year where the force triumphs over the evil empire. Look, you'll have the C's, right? China, commodity, currency, crude, but also contrarianism, and I think catalysts. So very different in terms of not more of the same. In 2016, you won't see those big mega growth names because the market is just so narrow. A handful of names driving all the major market averages. Instead, you start to see things either broaden out or you roll over. And broadening out, I mean things like small cap value, where they're below the radar screen. Look, we have an incredibly high regulatory burden. Compliance is brutal on some of these companies. They've cut costs to the bone. Look at a small bank in this country. They print on both sides of the paper, and they reuse every paper clip. So that is the potential catalyst. They've cut costs, a rising interest rate environment. These pay dividends. Those are areas that may actually do well next year, despite a frustrating economy. I also think if you look at what did very poorly this year, look at an area like commodities and energy. I don't think most strategists live in the real world where they recognize the amount of selling pressure at the end of the year, tax loss selling, hitting commodities, MLP, gold at the end of the year, emerging markets. That is a very narrow selling pressure.
Meaning you think all of those commodities will pick up in price coming in 2016?
I think that selling pressure will abate as the year-end tax loss selling gives way, and that gives us a traditional January effect, January bounce. I also think, Becky, that a lot of that is related to currency. And look, a lot of things can happen, a lot of surprises. The dollar is not an island. You don't get this divergent policy forever. If the dollar rolls over, you get any weakness in the dollar, that's going to be really good for oil, commodities, gold. It's going to be good for emerging market currencies as well. So I think there's a lot of potential catalysts. What did well this year is not likely to do well next year. And I think that's the important story, not looking at the major market averages.
Okay. Larry, what's your call for the stock markets just for the full year?
Talk about the Dow for a second. Some of those dogs of the Dow names, those high dividend-paying value names, really didn't have a lot of traction this year. I'd expect those stocks to do better. Those are, in many cases, dividend-paying names. Rates are not going to go up fast enough to replace the income that retirees need. But those stocks have been left behind, in part because of the strong dollar has been a headwind for corporate earnings. So I'd expect that to normalize, which would be beneficial for some of those big value names. I would also expect to see U.S. investors gravitate towards some of the international markets. So that becomes an opportunity. And potentially some easing and some improving in some of the credit markets. You know, Becky, one of the things I think is important to recognize is that there's a lot of surprises in next year. The presidential election is the least of which could have a major impact on the election, on the financial markets. And you could have a much tighter presidential election than most people think. And that could surprise and shock many of the financial markets next year.
All right, Larry, thank you for joining us today.